Hey guys, so this evening I want to do a couple other things with the bots, but I did want to do a class, or I guess more of like an introductory thing to day trading. I know a lot of people out there are maybe struggling in the economy or whatever, and are looking to trade each day to make some money, and maybe the market is really confusing. I want to break down a few very basic components that can allow you to do some day trading and make, a relatively small amount of money, but something to actually grow on as far as a learning curve goes, and some studies that you can do to improve your skills as well. Um, so I think, this being a basics overview or a basics class, I want to cover some things that might seem a little trivial to most people if you've been doing stock trading for a while, but some of the stuff you might see as useful anyways. So here we go. This is GameStop, and I'm using GameStop because um, GameStop attracted a lot of people on the stock market for a long time and still does, as a quick way to make money in an out of control stock gainer for a long time as well. So I'm going to use GameStop here and to kind of show you some pretty crazy things. So first things first, we have these little candles. This is a popular type of chart that stock traders will use. It's called a candlestick chart, and it has these little candles that basically simulate or show you price action or what the price did over that period of time. This right here, you can see in the watermark here, this is a 5 minute chart. I can also swap this to a 1 minute chart, which you can see the 1 minute gets quite a few more bars, obviously, because each bar represents 1 minute of time instead. Um, and this being a 1 day or a 10 minute chart, you can see from here, this little fade line to this little fade line is every 10 minutes of time that the market has been open. So each bar represents what the price actually did during that 10 minutes of time. Now it's important to note, and I'm going to go back and drop onto a 1 day chart. Now, a 1 day chart is the exact same thing. Each candle represents 1 day, but it's a little easier to understand a candle chart on the 1 day chart. So, just so you know, the bottom of the candle on a green one is the opening price. The top of the body of the candle, of a green candle, is the closing price. And the wick is how far the price went during that time, but it didn't hold, and how far down it went during that time, but it didn't hold and ended up coming back. Red candles are actually the reverse. It opens at the top and closes at the bottom, with the wicks actually representing the same exact thing. So during that day, we can see where the price started, how high it actually went, and where it closed at, and how low it went on that day as well. Your basic charts also have volume indicated down here, and the volume in red and green doesn't mean one is selling and one is buying. It more or less just means the amount of sales or the volume of sales that was actually done at that time. The only reason why this candle or this bar is green versus this one is because the candles are red and green up here. So that's actually mimicking that action. Okay, so that's your 1 day chart. Now, one of the things I'm going to work with is on the daily chart, because if you're new to stock trading, you should know that in order to day trade, you have to have at least, at the minimum, you have to have $25,000 in your account, in order to execute numerous amounts of day trades during the day. And I think it's like 3 or 4 day trades per every 5 days or something like that. But if you don't have 25,000, but if you do, you can actually execute as many trades as you want, which means you are a pattern day trader, or PDT, as is listed by the government, so to speak. So, one of the things we're going to note here, the reason why I chose to do the daily is because you can actually trade on a daily level with no matter how much money you have. And some of these companies actually allowed you to trade partials or a partial share. as well. So if we're looking at GameStop here, you can actually see the price over there to the side. The price on this one, $24, moving all the way up to $47. So one of the things I'm going to do is grab this tool and I'm going to mark how many dollars this thing actually moved during this span of time. Now this actually shows that it moved 102% or $24 during this particular time. Now that's a lot of movement for a stock, and GameStop moves rapidly fast, and it's one of the reasons why real, professional stock traders, I guess, would stay away from GameStop in most cases. But one of the things I want to show you is if you look back here, now what we're going to look at, I'm going to go ahead and make an adjustment here because I want you to look at one particular line. I don't want you to look at a bunch of them. I want you to look at one particular line. And let's see here. I'm going to turn off this one and this one. Click OK. Now this is what we call a moving average line. So this, or the simple moving average of the stock. It's just a rough line that kind of shows the averages on what the price has been over the past certain amount of days. Now on this actually controls it, this price, and I can move this up and down, but we've actually labeled this as a 50-day moving average, which means this is the average price it's been over the past 50 days and counting. So it actually is adding it up as it goes. Very clean chart moving along there. Now there's all sorts of things that stock traders like to do. One of the favorite ones is like, stock price, or like candlestick, different types of candlesticks that, this is the hanging man, and this is the, bullish engulfing and bearish engulfing, all these different types of things, which can actually confuse the new trader, because just because you see a hanging man or a bullish engulfing or whatever does not indicate that the stock is actually going to do exactly what that particular candlestick is going to do. Now that's actually not what that means. So reading candlesticks can help you in staying in a trade longer, or in basically improving your trading, but it will not give you a accurate trading strategy to run all the time. And now I'm going to be telling you a few specific things that are going to help in your trading, so I hope that you're actually taking notes. Now I'm not going to post anything on the screen or nothing like that. This is for you to take notes or not take notes. That's perfectly up to you. So this right here, this is, if you see this point hitting and this point hitting, this is what stock traders would refer to as like a double top, and then the market crashing on the other side of a double top. It basically can't break through this particular point, and it breaks on the other side. But a lot of these double tops aren't 100% accurate, as far as, is the double top at the candle body, or is it up here at the top? But you can only see it afterwards. You're like, oh yeah, see, this is a double top, and it's crashing down. But what I'm going to actually show you is something to do with this 50 moving average that's here. And it's a very simple line. And by the way, when I show you this stuff, everything can be scaled on some level. So I'm showing you on a daily chart, and then I'm actually going to show you on a 10-minute, then a 5-minute, and all the way down to a 1-minute chart to show you how these things actually coincide with each other, and how it actually works in a scaling on different charts. Okay, so you have this 50 moving average, and we're going to kind of zoom in or zoom out here, back up, and let's go ahead and look at a couple of these. So this one, look at how, now keep in mind this moving average is an average line. So when you see that price down below it, this price is below the 50-day moving average. So it's not just below this line, it's actually below its 50-day average, which means at some point in time, it's going to have to balance itself out which it does, it comes back up and begins riding on the 50-day moving average again. You're going to notice here, look, so the price comes over here, rides the 50-day moving average. So here we have average price action. And then all of a sudden it jumps up above and then takes off like a rocket. And we're going to map that price right there. Takes off like a rocket, moving $41 away from the 50-day moving average. Now, when it gets up this high, the moving average itself demands that it be corrected. Like the price has to pull back to average because this price up here is outrageous according to the 50-day average. So the 50-day average always gives you where the price is going to come back to. And you can see it actually moves and trends in different levels. But overall, and if you back up, this is what people find very interesting. If you back up, look at all these months in here where the price has just rode that 50-day moving average dead on, not moving whatsoever. And then all of a sudden, out of the blue, you get this random spike of activity. And you can also see the volume. You know, all of a sudden we got a bunch of people running in and buying this thing and selling it and a bunch of nonsense. But eventually it just goes up, and then the price is back to the moving average again. And then look, it comes up here, blah, and comes back down, and it's doing it again. So then we're back on the moving average again. And then all of a sudden we're up here again, and then it comes down, and then it breaks through the line. Still not much happening, not much happening. All of a sudden you see it rocket up through and trade above the 50-day moving average, back below it. I mean, it's just like back and forth. And if you zoom in, this is the kind of stuff that you're seeing. All the way down, all the way back up, all the way down, all the way back up. But that 50-day moving average shows the average. So it basically levels out the stock so that you can see the average is better, like where the price really should be. So now we're going to come back over here to this double top thing. Now watch closely as you see this giant bar here. This bar is right here as it rockets right through the 50-day moving average all the way up to here. And once it gets here, a lot of people kind of jump on board and ride it a little further before coming all the way back down here. Now, if you notice, this green candle means the stock opened at the 50-day moving average and rode all the way up. So basically gapped from 49.66 and opened at 44.81, which is insane, and rode all the way back up to $49. So this is a crazy price action. That's what's going on here. It rode all the way up and then jumped it all the way back down and it's back up. So crazy price action here. But notice how it came back and touched that 50-day moving average. It goes up again. It comes back to that 50-day moving average. So I want to show you this break type action and then it breaking below. Here's another bar, breaks below, runs low for a little bit, comes back up, rides it, comes back down. Here we go, breaking up. It rides all the way up and then actually forms, if you want to call this a double top, it forms that, and then here we go, back down again, another nice bar. Notice how clean this bar is, this extreme volume that it needs to push through this. And that's what we want to actually get to. The inertia it takes to push through this moving average line is pretty great. Anytime you see it crossing, you see a bar that's just a little bit bigger than the others or massive, you know. So you got this one over here is quite odd actually because it's just trickling down as it goes through. This one right here, it holds. It actually holds and builds back up before all of a sudden gaining speed and busting back out. And you can see the reaction based on its holding power. Like it didn't get a lot of inertia to break through it, but most of it didn't. Once it released, it actually shot up like crazy. So here we go, another one pushing through, another huge bar pushing through. And these are, you know, inertia movements that shove the price from below the 50-day moving average to above it. So what we're going to look at is when the stock actually crosses and a candlestick opens below the moving average. So we want it to open below it. And we might have to zoom in a little bit to actually see this thing do it. So right here you have it coming up. This is clearly above, this close and is clearly above the moving average. And then this one opens below it and then closes below it, closes above it again. But notice it's not a break. A break would indicate a clean open and close above the moving average. So a lot of times you get a nice push up through, but you don't know if it's going to just crash. And see this right here, crash, crash, crash. All this is not really working. This is another push up through, but you don't know if this one's real until you see this one. And notice how small this one is. It's kind of getting everybody in on this particular price. So it's crossed. This is an open and close on the other side. And as soon as it did, now you have the price jump, which it shoots up and goes into the sky and then ends up coming back down and all that. But this entry point is an open and close above or below the moving average. So here's another one that happens. You see it come down here and hold. This one almost did it. And I almost would say that you could actually get in after this candle right here. You would actually get in on this one. But this one right here, you know, definitely is the move. And if you got in on this one, or right after this one was done, you hopped in right here, you can see over the next, or that day, it actually moves down almost $5 or $4.50. A very stout move, even for a small amount of money. Of course, it shoots up, but doesn't actually break the entry point and ends up going all the way down to there. So even looking at that, that's a $7.30 moving average over the period of 1, 2, 3, 4, 5, 6. Quite a bit of money to be had there. And just so you can see that, I'm going to go ahead and load the scratch window here. That is a $7.21 move. Now let's just say, hold on, let's say you had $5,000. So $5,000, and we're going to divide that by the price of the stock, which would have been $49. So we'll divide by 49 equals 102 shares. So 102 shares times $7.21. That's a $735 move. So more than enough to actually pay for 5 days worth of movement. So it's a pretty good move on that stock. So let's go ahead and keep going on looking here. So here's another one. Now notice this one is a push up through here. So this is the clear break. Now you need a open and a close on the other side of this bar. And what you have here on this one is a solid open and close on the other side of the bar, which could get you in at the bottom right around in here. And you have a move of $7.86. So very similar to your previous move on that one as well. Now let's look at another one. Let's get this stock to actually mess up. So here we go. Here's another one. Breaks down through. Right here you have a solid open and close on there, and then look at this, scare you half to death. This one actually tries to go all the way back up through, which would have made you choke on your lunch, and then holds right here, but then goes down for a $2.47 move down here to the bottom. Not a very exciting move for 4 days. Probably would have been a little bit scary. But if you look at something, if you just held this thing for 1 day, that one, and all the way down to here, that's $2 move on one particular day. So anyway, this is not a great trade, but it would have kept you in. And if you would have gone all the way to here, you still could have got out and made a little bit of money on that one. Now we need it to mess up is what we're actually looking for, the strategy to actually mess up. So here we go. This one is a breakthrough, and then this one is a clear opening close on the other side. So this right here is your signal to get in. This right here is your buy-in, and the stock goes the wrong way. So this is the thing about strategies. A strategy is supposed to work more than 50% of the time, and the other times that it doesn't work, you're supposed to protect yourself with a stop loss based on a pullback percentage that you've seen it do. So I'm going to give you a little bit of homework here, and just about done here. You want to actually measure how much the stock has pulled back on the times when it won. So on the times it did good, like this one, boom, it does good, and you bought in on the next candle, how much did it pull back on there before it actually did a successful move? You look at this one, boom, they got the double here. How much does it pull back before it does a successful move? And you want to map that out, because that success, this one right here, how much did it pull back? None at all. It just went straight up. You got this one here, closes. How much did it pull back? Well, you can look from, this is the successful one. It opens here, falls to there, and it actually goes up 96 cents. So it's a pullback of 96 cents across there, which ends up going all the way up to $1.42, or a 3.51% pullback. So that has quite a bit of pullback before it actually makes the move it's supposed to make. So by mapping out that percentage point, you can then, when you get into a trade, your successful ones are only going to pull back the amount that you said. Any more than that, that isn't your trade anymore. Your stop loss is going to get you out, and you're not going to take that particular trade. Now here's another one. You close here, and then it goes down. This is the one you get in on, which would have opened way down here. Very scary on that one, and it shoots up. But what's the pullback on here before it does the move? You want to track that and measure it and know what kind of pullback you're in for, or what you should expect out of a successful trade. And then take it one step further after that and find out how far you want the stock to go before you're going to get out. Now keep in mind, you don't want it to go it's not going to go the entire way every time, and you're not going to make every single penny out of the stock. You're developing a strategy that's going to harvest small amounts of pay or small amounts of profit out of each one. Some are going to lose and some are going to win. You protect yourself on the losses, take as much as you can on the wins. That's the plan. So as you get in, let's say you got in, here we go. This is this one. You wait for the open and close on both sides. You hop in right here. This one goes up, and this is a 16.32% move. Well, we're not going to promise ourselves we're going to do 16.32 every time. We're probably going to back this up, I would say, to about, let's just make it safe, and go down here to a 9% move. Let's just call it 9%. Now, when we're over here measuring this stock right here, it probably isn't going to make a full 9% move. Well, that's down here a little bit, so it didn't make it. So we got kicked out on that one. Now we got another one. It goes here, hop in, close, boom, easily went up and actually did a 25% move, but we would have got out. We only needed it to go to the 9% mark, which is right there. Easily did it with no problem whatsoever, and would have made the money without any hesitation. Here's another one. It comes down, breaks below. You got to open and close on the other side. And here's the thing. You short the stock right here and wait. Look at that. 9% move with no problem. $4.26 happened without even batting an eye. Keep going over here. You got another one. Boom. It breaks above. Bam. You got that little pullback right here. We hop in. We're looking for a 9% move. By the second day, actually almost in the first day, but by the second day, you got a full 9% move with no problem whatsoever. So my concept here is to stop your profit at a certain point, protect yourself on the losses, and if it goes the wrong way, it's not a big deal. Let it go the wrong way, stop you out, and wait for the good ones to go. And when they go, have a measurement of where that stock's going to go just about every time, at the most, the most often that it makes that percentage move. Like this one right here is a 50% move. Well, you're not going to guarantee it's going to do 50, but you guys might want to work at a 16% one, because it looks like it probably could do that if you were willing to wait for it. So keep that in mind on this and work with that 50 line. Now I know I promised I would show you on the other charts, so we're just going to bounce in real quick. Now here we go. We have one here, open and close on the other side on the 5 minute, and then you see it jumps back across. This one would have been a failed trade. Over here, there's your entry point, open and close on the other side, and boom, There it is, and you got the ride up all the way to a 1.87% on the other side. Here's another one, comes down, open and close on the other side. And now you have a little bit of sloppy behavior right here. It goes back 0.66%, but ends up going all the way down to 1.41 on a complete move. Here's another one. Boom. It jumps across. Full open and close on the other side. Don't worry about not making this money right here. Don't even worry about that. Jump in on the next buy in and run up. You got a full 3.80 or more percent move on the other side. So this trade right here is very simple to read, and on a moving stock, you will have some bad ones. Like this is a bad one, but if you set your stop right, you'll kick yourself out of these with no problem. And the ones that, as soon as it went to the other side and did an open and close on the other side, you hop back in, and boom, you're back making money again. So, and some of them like these might kick you out because it does this sloppy action, which probably would stop you out. But as soon as it does a full open and close on the other side, after this test, it does a full open and close, you hop in and you're back making money again. So keep that in mind. That's what good trade strategies do. I'm not in any way saying that you should trade GameStop or trade these particular strategies. Not actually giving financial advice in any way. So guys, don't take it as that. You have to make your own choices when it comes to that. But I did want to show you something very simple when it comes to day trading and how to actually read stocks. Now, this stock right here, I mean, we could go back and back and back on this and look at days of successful trades on this. But what you need to do is to study when you're going to take it and when you're going to put your stop loss in. Because you take a day like this, when this right here, this is a test. Look at all these tests where it's trying to cross that line. So you're waiting. You're not getting in. If you are patient all the way through this right here, all of a sudden it's a clean open and close on the other side of that 50 line. And bam, you got to run up and look at that's a 12% move. It's really nice. Anyway, so each one of these moves is really nice, and you have to be disciplined in what you're doing and understand what's going on. I don't recommend taking this on without back testing, practice, and full on understanding what you're actually doing. But day trading itself doesn't have to be majorly complicated. You can do very simple things like this and produce a decent profit. So anyway, I hope that was helpful to everybody. Don't forget to join us in the morning, every morning from 8:25 to roughly 9:15, where we trade live using different bots that you can build to help with your trading every day. And yeah, that's it.